I'm also going to give an empirical paper, and it's going to duplicate a little bit of what Michele has already talked about. I guess we all know that neoclassical finance hasn't worked all that well in the last few years. It hasn't provided a very good explanation of the crisis that our financial markets have undergone. And it also has generated anomalies which have just been massively documented in the preceding paper. And I'm going to try to present a review of the empirical literature that is a bit idiosyncratic in the sense that it's going to, I'm going to structure it in such a way as to encourage you to the opinion that the problems that we have with established finance theory are not minor, and they're not matters of detail, but they're fundamental. In particular, I'm going to try to summarize the data in such a way as to suggest that relaxing rational expectations is necessary if we're going to come up with models that are empirically adequate. I realize here that I'm preaching to the choir in this setting, but it's more, I'm actually preaching mostly for myself because I've been a great advocate of rational expectations. But I just don't see how the problems that we have with this empirical work are going to be solved in a framework that completely maintains rational expectations. So let me start with a review. There's not going to be any theory in this paper, so to the extent that there is any theory implicit in the empirical work I'm going to be surveying, it's variants of the Lucas tree economy. And let me go back to the early precursors of contemporary finance and start there. Earlier than the random walk and martingale models, things just don't connect with modern issues. But I think that the random walk model and in particular the martingale model does make that connection. The essential idea of the martingale model is that returns are unforecastable. And there's a simple and intuitive argument why you'd expect that to be true in a well-functioning neoclassical framework. And that is that if agents expected prices to rise, they would have already risen. And this is the intuition that we talk about all the time in our undergraduate classes. And it's at least valid at a first pass through the data that we would expect that to be the case. So that's the martingale model. Theories are theories. If capital markets are efficient, our theories ought to be implying that stock returns are unpredictable. And from the martingale definition, we can solve that using a result from Samuelson to show that that's equivalent to the proposition that stock prices equal discounted expected dividends, where the discount rate is constant. That's almost equivalent to the proposition that returns are unforecastable. So empirically, we can test that proposition, and the simplest test is to look at autocorrelations of returns, so that if markets are efficient, returns should have zero autocorrelation, so that a low return will not forecast either a low or a high return in the future. Other tests would have the regression of returns on any currently observable variables, future returns that is, on any currently observable variable should also have a zero coefficient. And the early evidence on efficient capital markets, which I summarized in various papers, but was also summarized by Eugene Fama in his classic paper, was favorable to that proposition. The relevant coefficients were not equal to zero, but statistically indistinguishable from zero, suggesting that, yes, the stock market looks like an efficient capital market. More recently, evidence has pointed in the opposite direction. As Michela just summarized, it looks as though stock prices are more volatile than is consistent with market efficiency. Specifically, if markets are efficient and we have the present value model with a constant discount rate, the volatility of stock prices ought to be related to the volatility of dividends, which is not very high. And it looks as though, contrary to that, stock prices are more volatile than the volatility of dividends justifies. Also, the equity premium puzzle, she also summarized, I won't repeat any of that. The equity premium is higher than can be justified by a consumption-based asset pricing model with a coefficient of risk aversion in the normal range, which is 1 or 2 or something like that. You need a number like 55, which is not credible in order to get the volatility, in order to get the equity premium that we see in the data. Both of these classes of evidence, however, were ambiguous. The return autocorrelation, while being of borderline significance statistically, it's not clearly insignificant economically. Returns do have some autocorrelation at intervals of 3 to 5 years, maybe 15 or 20 or 25% of the variation of returns is predictable by dividend yields, or at least has been in the past. The recent evidence is that's not so clear. Similarly, the variance bounds test turned out to have a series of econometric problems that convinced many people who looked at that literature that there was no excess volatility, that this is exactly what we should be expecting in an efficient capital markets. And I'm not going to obviously review that literature. So the upshot of these studies was there was evidence on both sides as to the correctness of the efficient markets model empirically. I would say that now there are new methods, which, again, Michela has summarized based on log linearizations that seem to me to resolve that question definitively. And in particular, they're free of the kind of econometric problems that are involved in the variance bounds tests. So I'm going to summarize in a little more detail the log linearization method that was introduced by Campbell and Schiller and used by Cochrane in 2 recent papers, which I consider to be very important, that they clearly establish that returns are forecastable. So let's start with the definition of the rate of return, which, as you see there, the rate of return is the sum of the rate of capital gain, PT plus 1 over PT, plus the dividend yield, dt plus 1 over pt. Now, as simple as that definition is, it's kind of troublesome because it's neither linear nor log linear. It has both addition and division in it. So that conclusion follows. And what the obvious, with hindsight, idea of Campbell and Schiller was to approximate this definition by a log linear expression, which will allow us to make much easier calculations. And here's what you get if you do that, which looks pretty much the same as what she had up there, what Michela had up there. That the return here shows on the left-hand side, and it's depends on the lowercase level. The lowercase variables there are logs. It's a constant rho, which is based on the log linearization. And the first term is the future price less dividends. Second term is dividend growth. Third term is current price less dividends. And this, of course, has the convenient property that's linear in logs. And the linearization is pretty accurate. Not completely accurate, but pretty accurate. And so what that says is that the return is high if either the next period price is high, or the dividend growth rate is high, or the current price is low. And this is convenient, obviously, because it's additive, but also because it involves the intensive variables that we're interested in. The return is an intensive, namely the variables that you expect to be stationary in a stochastic steady state. Obviously, all these variables, dividends, stock prices, have trends, but the ratio of the price-dividend ratio and the rate of return, those kinds of variables look like they don't have trends. So we get for free that we don't have to worry particularly about trend correction if we use these log linearizations. And that's really convenient because trend correction is difficult in the context of the variance bounds analysis, as exemplified by the fact that I believe that Porter and I didn't get it right in our paper. What's so attractive about this formula is that it's just an identity, namely there's no theory involved. It's just derived by log linearizing the definition of the rate of return. The sources for this material, again, Campbell and Schiller's 1988 paper, and two recent papers by Cochrane. One is in the Review of Financial Studies, and the second is his presidential address to the American Finance Association in the Journal of Finance for last year. There's also a paper I'm going to refer to by Lansing and myself, which is on my website. The Cochrane paper, particularly the 2008 Cochrane paper, it's really a frustrating paper if you try to read it because he didn't write it very carefully. And if you're like me, you'll give up on it 6 or 8 times before you finally get through it. But I would encourage you to persevere because the point he's making is very important, I think. And I believe the analysis is correct. So that he has a style of writing that I find very challenging. So back to the definition of the rate of return, we can get a relation that looks a lot like the present value model by iterating that expression. So if we take PT plus 1 minus DT plus 1, we can take this equation, replace T by T plus 1, substitute iteratively, keep doing that, and assume convergence, you get that first relation there. And the left-hand side there is the dividend yield, the log dividend yield, which is best interpreted as prices, as the reciprocal of stock prices measured in units of dividends. So it's the reciprocal of the dividend price ratio. And that is approximately equal to the discounted value of future returns minus the discounted value of dividend growth. And this is quite striking, considering it's a present value relation that is derived without benefit of any theory. And what it says is the dividend yield is low if either future stock returns are going to be low or dividend growth is going to be high, or both. If neither of those is true, so that both those variables are constant, then price is going to be a constant multiple of dividends. So the only substantive assumption involved in deriving that relation is that the infinite sums converge, which basically rules out bubbles, which admittedly is substantive. And Cochrane doesn't show any misgivings about that because he actually looks at these variables and verifies that they are stationary empirically, as they would not be if they had bubbles. So this is almost for free, this relation. You can also take conditional expectations on that equation and get the lower formula there. Now, from that equation, we can form the covariance, we can form the variance of the price-dividend ratio. And that turns out to be the difference between the covariance of the dividend yield with future discounted returns, that infinite sum, minus the covariance of the dividend price ratio with discounted future dividends. Okay, and here, again, let me point out how much we've gotten for a very small input of restrictive assumptions. We have that if the volatility of prices is numerically equal to the difference between the predictability of future stock returns minus the predictable component of dividend growth, where the covariance is with the current price-dividend ratio. Again, it's an identity. This must be true in any model in which dividends are excluded, in which bubbles are excluded. Another way to look at this formula is to divide through by the left-hand side variable and get that the difference, I say this wrong in that last statement, but the difference between the regression coefficient of returns on the dividend price ratio and the regression coefficient of dividend growth on the dividend price ratio is 1. The difference between those two coefficients must be 1. Again, that must be true without restriction on the theory that is generating stock prices, so long as it excludes bubbles so that we can be assured of the convergence of those infinite sums. It's quite striking. Now, market efficiency, as we just defined it, says returns are not forecastable. That means that the stock price volatility is due entirely to the forecastability of dividend growth. And so we have two distinct tests of market efficiency. The direct test, what I call the direct test, which is to see if the regression of future returns on the current yield does in fact equal 0. But the null hypothesis of market efficiency can equally well be tested by determining if the regression of future dividend growth on current yields equals 1. These are tests of the same null hypothesis because of the identity that I just derived. And they give different answers. Empirically, dividends are pretty close to being unforecastable, meaning that basically dividends look pretty close to a random walk. Not exactly a random walk, but pretty close. If we do the test the direct test of market efficiency, we get, as I noted a while ago, we have a weak rejection or a borderline case. You could argue that the T is within the rejection region, or you could argue the opposite. But the indirect test gives a much stronger rejection. It's very clear that stock prices, the forecastability of stock prices, the relevant regression coefficient in the indirect test, is way different from 1. It's very close to 0 because dividend growth is basically it's not forecastable using price-dividend ratio. So this is the theme of Cochrane's paper that I cited earlier, which is that we have two different statistical implications of the same null hypothesis of market efficiency. The one people usually think of indicates it's sort of a borderline case. And so the evidence is not clearly either favorable or unfavorable to market efficiency. But the indirect test is very strongly against market efficiency. Basically, for Cochrane, the story that he wants to tell is that market efficiency says all of the predictable variation in stock prices comes from dividend growth. None of it comes from return forecastability. The data say pretty much the opposite. Almost nothing comes from dividend growth, and therefore, it basically all comes from return forecastability. Very striking. So as far as Cochrane's concerned, and I think he's right about this, well, of course, this is this is the same implication that we got in the variance bounds study, but basically that stock prices are too volatile to be consistent with market efficiency. But what Cochrane is doing is inferring that conclusion from the associated implication that returns have a large forecastable component, and that's logically equivalent to the statement that stock prices are highly volatile. Now, there's one loose end here, which is, what about risk aversion? And I basically went quickly over the assertion that market efficiency implies the unpredictability of future returns. That's strictly true only if agents are risk neutral. If agents are risk averse, you could certainly write down an equilibrium model in which risk varies over time, and if you look at the equilibrium associated with that, it will have that expected returns vary over time in a way that may or may not be predictable. So yeah, almost done. So that's correct, but it does not look like risk aversion is a candidate for an explanation for the predictability of returns. If you do the variance decomposition, breaking down returns into risk-free return minus excess, or plus excess return, then you have a three-way covariance sum. Risk aversion implies that the variation in stock prices is due to the risk-free return, whereas the data say no, the risk-free return is pretty much unforecastable. The data, the relevant covariance that's non-zero is that on excess returns. So risk aversion, while it in principle could generate some forecastability of returns, it looks as though empirically it's not nearly enough. Also, and this is my paper with Lansing that I cited earlier, risk aversion, you need rates of constant relative risk aversion on the order of 5 in order to justify the volatility of stock prices that we see, and that's just not a credible number. If you get much above 2, then you're in a region where people are implausibly risk averse. So we can't really explain the high forecastability of returns using risk aversion as a story. So the problem we have is, how do we model forecastable returns? In order to justify how do we model forecastable returns? we need a model. We know that we want to match the volatility that we see in the data of stock prices. We know that that volatility is associated with predictability of returns. So we need to come up with models that imply that about 20 or 30% of the return variation is forecastable. How are we going to do that? Can we, in other words, can we do that in a model that assumes rational expectations? In other words, are we willing to assume that people know that returns are forecastable as is implied by rational expectations? And I would say, first of all, I'd say that's pretty implausible. I just don't believe people have that. I believe that when we look at the data where people talk about when people talk about the riskiness of the economy, they don't see any ability to forecast it. So it seems to me that risk aversion can't be, that full rational expectations can't be part of the deal. And so what we're going to do is, this is the part of the paper that I haven't written yet, so I can't really defend it. But what I want to do is come up with a model that looks like a Lucas tree economy, but I'm going to assume that the degree of risk aversion is itself a stochastic process that is mean reverting. As I believe is true empirically, we have high risk aversion. Within a year or two, the risk aversion reverts to normal. Have low risk aversion, the same thing is true, it reverts to normal. But I'm going to assume that agents in the economy do not have rational expectations about the persistence of risk aversion. So I'm going to assume they price assets, price stocks in particular, based on the assumption that the coefficient of relative risk aversion stays constant over time. And that's going to imply that stock returns are choppier than they would be if they had rational expectations, because they treat each change in risk aversion as if it were permanent. And so that's going to generate price volatility, and by the identity that I talked about earlier, that's going to, I believe, generate the degree of risk forecastability that we see in the data, at least if I parameterize it correctly. But as I say, I haven't done that yet. It seems like it's a promising project, and it seems like qualitatively it will produce will produce stock prices with the kind of volatility that we see in the data. If anybody's interested in corresponding with me about this, I'd be happy to talk to you, because I haven't done it yet, and we'll see how that turns out. Thank you very much.